Hello and welcome to our GCV Analytics webinar. Today, we're hosting a discussion around the first quarter corporate venture data and the state of the market report by our partners and sponsors, Silicon Valley Bank. I'm delighted to welcome as guest speaker today, Alex McCracken, who's Managing Director at SVB. And of course, along with me is our founder and editor-in-chief, Jim Mawson, who will be leading the discussion with Alex a little bit later. However, before that, just a few words about who we are and some of our upcoming events. Over the past decade, global corporate venturing has been centered around two key questions. Who does corporate venturing and what do they do? And similarly, its sister publication, Global University Venturing, has been centered on innovation stemming from academia. Our GCV Analytics service, which I happen to head, visualizes the data that we gather through these two publications. We have also launched the GCV Institute, which provides opportunities for training for up-and-coming CVCs. And with the Leadership Society, we try to bring together the entire corporate venture community. And now, without further ado, our guest speaker, Alex McCracken, and Jim, over to you.
Wonderful. Well, thank you so much for that, Kalyan. Really appreciate the introduction there, and delighted to be back for our quarterly series. And it feels like it's a year ago, almost to the day, that we were talking to SVB and trying to understand and unpick what the implications for COVID-19 were. Roll the calendar forward 12 months, and we'll be talking on this latest webinar about three main items. One, the sort of first quarter's wall of cash, which has been erupted. The second, which is starting to be the disruption it's causing to the overall venture ecosystem. And the third, given SVB's sort of status as probably the world's most important innovation economy bank, to understand the entrepreneurs and the venture investors of all different types, to understand how do you understand how to build a portfolio, and how do you understand some of the risks that you can sort of be catering to. Obviously, the past year has seen the pandemic, the COVID-19 pandemic. So we'll be trying to look through what some of the other risks and what some of the opportunities and trends that is causing the been are. So welcome, Alex. Thanks for being able to join us.
Thanks, Jim. Look forward to the discussion.
Perfect. Well, let's get started straight off with a little bit of the view, which probably was counterintuitive to what people were thinking about this time a year ago, which is the record numbers of corporates who have come into the market through COVID-19. You know, we've seen obviously an increased number of established corporates, those who have been around 10, 20 years or more, continuing to invest quarter by quarter through COVID-19. But the fact that we've seen a record number of new corporates doing their first deals has probably been a little bit counterintuitive, given what people had anticipated when the COVID first hit. Is that how you've seen it, Alex?
Yeah, I think we were all surprised by the bounce back. Once we got through Q2 last year, things returned really quickly to the rapid pace of investment, both from corporates, VCs, non-traditional investors, asset managers. Everyone sort of saw the opportunity to keep doing deals through Zoom, to go cross-border where necessary, and bet on the things that clearly COVID had accelerated: digital adoption. So yeah, pleasantly surprised and great to see a good H2 and in 2020, and obviously a good Q1 this year in many areas, including some bits we're starting to see come back, that got hit quite hard, like travel, hospitality. A lot of the better ones got through the past 12 months and see the positives as things open up again.
Yeah, I remember a year ago, Alex, you were describing how SVB was almost first off the blocks to try and use the sort of downturn or the dislocation that COVID was starting to cause to try and engage more with the entrepreneurs or VCs that you really wanted to do so. Has that sort of paid dividends for the bank?
Definitely. And one of the big things we discussed back in Q2 was how we show face to market, clearly in what was a challenging time. And we did say, we want to be seen at the end of this, whenever the end was, and we didn't know, and we're still not at the end, of course, but we wanted to be known as being there, supporting our clients, supporting our VC partners, and actually leaning in. Now we've done that before in previous downturns, but nothing we weren't as big, and but the strategy paid off back in 2008 and back in 2001, and we actually found that we built stronger relationships with VCs and top entrepreneurs in those difficult times than when times are good. And so we learned through previous downturns to do that. We deliberately stepped in this time and executed policies like forgiving loan repayments for 6 months, for example, in many cases, getting behind a lot of the government support schemes, payment protection program, etc., making sure we called on our venture capital friends and partners, as well as top companies, and say, hey, we're there for you. What can we do? Let's have a conversation. And yeah, we really felt that we built stronger bridges, and that's, how we have to differentiate. Debt can be a commodity, banking can be a commodity, but relationships are built over decades. And so we definitely try and lean on the relationship first, transaction second.
Yeah, it's great. Glad it's paid off so well. It's really important. And what we've seen, just to go back to the first quarter, this sort of wall of cash, is a real spike up in the large deals, those 100 million plus rounds. These are GCV analytics data of corporate backed deals, and corporates will come on to later, have really driven the overall size of the sort of first quarter deal volumes and value. But that's been in part not because of an increase per se in the volume of deals, but in the value, particularly at the top end or large end size. So I think GCV tracked more than 165 deals in which corporates were involved of at least 100 million in size. Of those, 17 were more worth at least $500 million or size, which is phenomenal. If you roll the clock back even sort of 5 years ago, let alone 10 years ago, you probably would struggle to see more than a handful of $100 million deals per quarter, and now we're seeing effectively a couple of them per day. Is that sort of what you're seeing more generally as a bank, Alex?
Definitely, these mega rounds are out there, and I think it's reflective of a few key trends. So clearly, the brand name VCs that have been around for decades now tend to be raising ever larger funds, and our latest analysis showed, I think, that 10% of the largest funds in the US raised 68% of the funding in 2020. Clearly, we're getting multi-billion funds. So SVB Capital, in our fund of funds, we're in not only emerging investors, but also the brand name investors, some of which are, putting out billions or have billions in funding. The other thing is that the top 1% of deals saw 30% of VC dollars in the US in 2020. Just 1% of deals by volume saw 30% of the dollars by value. And so there's a clear bifurcation going on where big funds, brand name funds, have a lot to put out. Clearly, some of the good, growth stage companies are growing fast, can absorb, a few $100 million of capital to grow even faster, delaying the exit, onto the public markets ever longer if they need to. So we're definitely spotting this trend of, it's almost a barbell strategy. There's a lot of VC has gone bigger and later where possible, and have raised opportunities funds as well to go late into some of their portfolio and follow on. But clearly there's also a retreat back to safety and some smaller early stage investments. So, you know, the likes of an Index Ventures, which has funds from seed through to venture through to growth and opportunities, you know, actually their latest funds were seed funds. And I think as people are seeing these valuations creep up and up as these big rounds come in at very, very high multiples on the valuation front, you know, a lot of people are starting to think, I'm going to come in a bit earlier now and take some early stage risk.
Yeah, interesting. Okay, and so just to sort of run through that, obviously, if you take the sort of first quarter, you know, it was a record overall in terms of more than 1,000 deals of 56 billion in total that was raised by those entrepreneurs. But when you look at the overall venture ecosystem, just as Alex was describing, the Q1 was its first quarter of more than $100 billion raised in total. So VCs, you know, while only being in a fraction of the volume of deals, CVCs were, you know, in about half or about a third to more of the total by value of the deals done. And it was, as exactly as Alex says, this massive step up in the later stage deals. You know, and what we're finding is that that's then sort of this wall of cash isn't just going into the rounds, it's also coming out, particularly driven by the SPACs and hence into IPOs as well. Again, is that what you're seeing sort of more generally, that almost we're seeing this sort of, you know, the exit markets being as hot as the investment markets, and that's not always been the case, is it, Alex?
Yeah, exactly. The window's open right now. Every VC or CVC I'm talking to is really thinking where possible, you know, about getting their portfolios exits. We're hearing a lot of companies just getting called by the hundreds of SPACs that are out there. Clearly, most of those are in the US, but they're also looking internationally. We've got a few SPACs in the UK and Europe now emerging. So it's great time for exiting where possible. Not just SPACs or IPOs for the headline ones, but, you know, also private equity is buying. There's still M&A happening, although, you know, we've got some concerns around some of the antitrust regulation that's happening on that. But yeah, for the time being, SPACs are hot, but we will wait to see what happens with the outcome of some of these mergers.
Yeah, I think that's spot on. And just as you were describing, you know, we've actually seen, while there's still a lot of venture-backed M&A activity, particularly in the US, it is a decline from where it has been, as, you know, some of those alternatives are going towards the SPAC market. And the FT describes, you know, just this sort of record first quarter of, you know, of companies, like a 10-fold increase in the number of IPOs in the first quarter compared to the whole of last year. 3/4 of those were SPACs. So it has been a phenomenal quarter. How long it lasts, there's already sort of, you know, bit of froth being blown off some of the sort of SPAC market, but how long the IPO market as well as SPACs continues, it is a different game out there at the moment. And what that's driving is, obviously, if you get lots of exits as well as lots of investments, you start to see people particularly keen to invest in some of the VCs. Obviously, as you mentioned, Alex, SVB has its capital arm, which is to fund the funds business. We're seeing a lot of corporates not just be set up as new CVC units, but also spin off various operations, particularly those with a good track record to raise third-party institutional limited party capital, as well as corporates back in some of the VC funds in specialist regions and sectors as well. So, you know, are you finding a lot of that in the UK and Europe as well, given sort of the experienced group? If you had to find a group of CVC managers, when we talked about this 12 months ago, you know, Alex, the expectation was that we would see corporates that maybe didn't have the free cash flows, they were hit by COVID on their sort of balance sheets, you know, open their corporate venturing units up to third-party capital. Are you seeing, you know, some of that activity? Are those groups that you think could be quite exciting as well, Alex?
Yeah, so I mean, I think the CVCs have been around, you know, decades and got track record and the exits, and pretty much look like VCs now. They spun out a while ago. They raised from multiple LPs in many cases, and they're very, very financial return driven, albeit they have this connection to the corporate who is but one LP now, or you know, a majority LP, but still it's an arm's length group. So I think what we've got now is the second wave of CVCs who probably formed within the last decade and don't quite have the track record, but they're seeing, you know, the model of what happened with Google or Salesforce or Sapphire, you know, et cetera, doing the spin out. So they are forming their own spin outs, raising from multiple LPs. You know, they've got 5 to 10 years of experience. They're bringing in experienced partners and spinning out. And then you've got this other wave of the newer CVCs, we think, who are relatively young, you know, in age, in terms of a few years of formation, still investing off balance sheet, possibly thinking about spinning out, but don't quite have the track record yet to go to other LPs and actually, you know, raise a separate fund. So I think, you know, we're at the moment in this seeing spin outs more of the companies with 5 to 10 years track record rather than you know, 1 to 3.
Yeah, that makes absolute sense. I think, you know, that sort of almost is becoming a hybridization, trying to take the best of the CVC in terms of the value add and align it to the best of the VC in terms of governance and sort of being able to raise more capital from a wider source of people. You know, and so that's been one of the sort of the big pushes by Scott Sandell, who's the managing partner of NEA, to form the Global Innovation Venture, which is a sort of group of the top tier VCs who want to then link with the CVCs and ultimately, I think, provide both a more efficient allocation of capital to the better entrepreneurs, but also provide those entrepreneurs, provide her with effectively more the value add. You know, ultimately she's really looking for about 5 or 6 things: capital, customers, product development, hiring, and an exit, and maybe a regulatory or antitrust sort of perspective as well as a 6th. But if you take those 5 or 6 sort of options, the best of the corporates can really add a lot of value, and the best of the VCs can really help the governance and help the sort of allocation of capital to those that really can use it most effectively. So I think we're going to see a lot more of this, and we'll be excited to talk more about Global Innovation Venture in our July Digital Forum, which we're coming up on the 28th as well. But all that means is that we're seeing quite a lot of disruption to the venture market. If we go to the sort of second sort of bullet point from the agenda item, the second sort of 15, 20 minutes or so, what we're seeing is not just that sort of focus on value add, helping the entrepreneur who goes through the business of scaling up a startup, but also thinking about how does this wall of capital get applied, as you said, Alex, that top 1%, if they raised 30% of the dollars last year, you know, we're seeing that almost be amplified in groups like Tiger and some of the other hedge funds or mutual funds, really trying to put a lot more capital to work a lot more quickly. You know, what does that mean in terms of sort of market consolidation and disruption as you think about who you want to work with and who you want to bank with?
Mm-hmm. So, and we look at it 3 ways, you know, because clearly we want to lend into the best portfolio companies and bank them. We want to direct co-invest with the best VCs, especially at Series A and B. And we also want to be an LP in the best funds. So we're considering all 3 areas. And I guess the commonality across all 3 strategies is to work with funds who ideally have a good track record, either, you know, because they've been doing it for years in that fund, and clearly, you know, we've got some experience either lending or investing in their portfolio, and we know how they treat their portfolio companies, as in, you know, are they supportive where possible? Are they good partners to their co-investors? Are they communicative? That's very important to us. But clearly also we are getting to know a number of newer managers, whether that's on the CVC front or VC front. And clearly those people in our ideal world will have been in a brand name unit before, have good experience, you know, and a good track record from another fund before maybe jumping ship and setting up their own new unit. So those emerging managers that we work with, invest alongside or lend into their companies, we're really actually looking at their track record in previous funds as well. And then we will take that risk. Where we're a lot more cautious and probably, you know, sitting on our hands a bit is where, you know, it's a completely unknown, you know, it's an unknown person that we haven't worked with before in their previous life, or it's an unknown geography to us where we haven't done a deal before, or it's a really nascent sector, which we're taking our time to understand. So, you know, that's how we mitigate risk. But clearly, you know, when you've got hedge funds with billions under management, and we will have had some experience of lending or investing into their companies before, so we can look at how that's performed. We can look at who they're co-investing with, and, you know, candidly, are they picking a lot of good companies that are exiting? You know, we can do that analysis, especially at growth to late stage.
Yeah, I was going to ask on that, particularly, you know, you look at sort of Coatue or sort of D1 and Tiger and a whole host of the sort of mutual funds, which are massively sort of, you know, sized in terms of and sophistication, like the BlackRocks and Fidelities of the world. You know, are there any sort of differences in terms of how you know, given the size of checks that are writing, does that sort of change the risk perception of whether you would bank the portfolio companies, you know, and, you know, are you finding that actually you want to co-invest alongside them given the size and the later stage, or is that a sort of an area which is, you know, it's not really much of a value add from your perspective?
So we would definitely want to bank the companies provided they're tech or med tech. In terms of lending at late stage, you know, with big rounds coming in, we definitely do look at that and lend into many of those companies that have mega rounds. Clearly, because most of them are growth to late stage, they have revenues, they are lendable, you know, they need working capital, they need credit lines. So even if a large equity check's gone in and they don't necessarily need a loan, they might need working capital or credit or trade finance. So yes, we're very interested in that side. We wouldn't, as SVB Capital on the fund of fund side, be looking to invest in their fund or be any sort of, you know, LP, and we wouldn't with SVB Capital Direct be looking to deviate too far from our strategy of investing at Series A and B into, you know, into companies backed by VCs where we're already an LP, which is how we mitigate risk there. So it really, on the late stage hedge funds, etc., it's very much a lending relationship, but provided that their company's backed also with co-investors that we know and have known well for many years.
Interesting. That's really interesting. Like I say, there's a lot of change out there. This is a sort of a presentation prepared by Insight, actually, which was quite good, actually. It was looking at some of the early warning signs of some of the disruption that's happening to the overall venture market. Scott Anstey prepared this, and you know, it was really interesting to see, you know, how they were seeing the sort of almost the Clay Christensen disruptive innovation being applied to the venture market, you know, in terms of thinking about how strong LPs were to reinvest with the same names, whether that flow of capital was changing, whether the policy was starting to affect what could be a VC or how money could get applied to some of the private entrepreneurs, and whether some of the sort of, the changes to the sort of not just the regulatory, but also the technology of how you source and find deals would also disrupt the sort of the overall venture market, and what the entrepreneurs would use the money for, whether that was changing in terms of the types of business. So it felt like, just looking down the list, that there was a lot of change. The model of, a 2.5 and maybe 20-25% carry, delivered over, say, 3 to 5 years, and then over the next 5 to 7 to 8 years, get those exits back. That model, which fundamentally was pretty unchanged for about 70 years after the Second World War. In the past decade, we've seen a lot of changes. We've seen, not just the corporates really come in en masse and scale up the industry and professionalize it, but we're seeing the mutual funds and hedge funds really take a different approach, a lower rate of return, but a faster and a greater amount of capital, to be able to deliver back the returns to their investors, which is a different approach. So I just wonder here, Alex, as you look down sort of the list of disruptions, which ones do you think are probably going to be most important or influential, to in the venture capital market, or do you think they all are?
Well, I think the policy changes immediately springs to mind, because there's so many things going on where, they've just increased the funding limit for crowdfunding in the US, for example, from 1 million to 5 million. And so clearly if that increases, and some of the tax benefits that are being mooted that, already exist in the UK for encouraging angel and seed investing, that if that continues, that has nibbled away in the UK at the early stage, traditionally, used to be occupied by VCs at seed and A. Now that sort of crowdfunding and angel investing and seed investing, there's many more individuals doing it, and therefore VCs are allowed to go sort of A and B and a bit later. However, at the far end, my colleague Melina wrote an excellent article on, summarizing the antitrust sort of sentiment on the Capitol Hill. It's mirrored again in the UK. A lot of deals, M&A deals now, large deals, are being reviewed by competition authorities. So clearly, if M&A is hindered to some extent by regulation and competition markets authority, that's not good news for venture. It's hopefully a relatively small number, and it's being compensated by positive regulatory changes on opening up the AIM market and London listings, for example, on the stock market, lighter touch regulation to encourage more companies to go public, is a positive. And then, clearly the innovation around SPACs, well, it sounds innovative, but, people have been doing it for decades. That's opened up the exit market. So you've had innovation at the early stage, you've had innovation at the exit stage. So it's allowed VCs to sort of move their strategies a little bit in the middle. And clearly that 2 and 20 model, as you say, that's been iterated on. A lot of LPs have put pressure on fees and said, come up with different models. So we're seeing the rise of a lot of deal by deal models. We're seeing, lower management fees, especially from experienced VCs saying, well, I don't need 2%, I could do 1%. I might only take 15% carry in some cases. So I think those are the ones that spring to mind. I could go on longer, but you asked me for the top 1 or 2, so that's what sprang to mind.
That's really helpful, Alex. I see we've got some questions coming in. We'll pick up some questions towards the end. We'll just make sure we cover the 3 main bullet points before we come to you, David. So, but thank you for that. And then just the sort of the other part is, again, if I think about where SVB plays, you know, it's very much across that whole understanding of the innovation economy, you know, understands the entrepreneurs, understands the investors, understands the sort of the banking and risk and regulatory environment that these groups play in around the technology sector, obviously particularly focused. But if we think about the venture market as a sort of raising capital, sourcing deals, identify, selecting, striking the best terms, you know, and then ultimately supporting and exiting, we're seeing a lot more almost niche players within that. It's not necessarily that each firm has to do all of it well. You know, maybe they specialize in different areas, or maybe not. They have to get better and work with the best partners at each of those individual levels if they're really going to, you know, sort of scale up and deliver. What are your feelings around sort of this professionalization question, Alex? You know, what do firms really have to do well? Do they have to do it all, or can they concentrate in bits and become really well known at something rather?
Well, I think it all depends on size, because clearly, you know, bigger funds, more mature funds, and they have the fee income to be able to, say, for example, hire operational partners to do all the supporting. So clearly that then allows the GPs to do the sourcing and selection, and also some of them tend to have, you know, older GPs who, you know, are well known to the LPs, so they move away from the sourcing and selection and just sort of stick to fundraising. And you know, we're definitely seeing that on the larger funds and more established funds. I think the emerging funds really, you know, still concentrate on the, well, I'll raise, but I'll source, you know, and find an edge for selection, and that's it. That I'm just money in, place my bets. I haven't got time to support the company because I'm early stage and I'm just placing bets, and I just hope, you know, a good few of them carry on and do well. But you know, what's also equally clear is, so we in the UK, you know, we're constantly witnessing US funds with a very different approach, just phoning our portfolio companies from the US, you know, hey, we've combed the market, we like you, here's a preemptive term sheet, you know, we know you're investors. There's very little DD, or maybe all the DD's been done in the background, but you know, certainly the companies have told us there doesn't seem to be that much DD before the preemptive term sheet. And you know, just the speed of the velocity, the speed of transaction when it's done, the valuations, it's like, you know, we'll just go 1.5x on whatever your closest term sheet is, blow them out of the water on quantum. And that kind of transactional high velocity investing is definitely a new trend. And you know, it's been in place in the US a lot, but we're now seeing it more in Europe as those US funds are coming over to Europe to do deals. And I think this is opportunity, but also concern in some cases. And you know, maybe we will come to that later. And I think provided, you know, people really do know what they're doing, and they've done it before, and they absolutely know a sector, you know, then move as fast as possible. If you have that conviction and knowledge and skill, go as fast as you can. The entrepreneurs welcome it, and it's how you win a deal. Equally, if you are more cautious and take your time to deliberate, but you truly can add value beyond money, and the entrepreneur believes you can do it and you've done it before, you know, yeah, you could probably take a bit more time and win on the value add. But the ideal is that everyone speeds up and adds value as much as possible, because that's what the entrepreneurs are looking for. And you know, where the capital is, it's definitely an entrepreneur favorite environment right now. The balance of power is with the entrepreneurs to choose, or the best entrepreneurs to choose the best funds and the best capital.
Interesting. I mean, this is a sort of reference. I showed it, that sort of little GIF at the start, sort of wall of money coming out of the sort of photocopier machine, just as this 4 trillion or so has been sort of, signed off by the US Treasury alone in terms of so far this year. But, Everett Randall, who did the sort of a really nice post on Tiger, had this little chart which kind of almost separated the VCs out from the sort of those that were trying to add value, and help, and could do some good stuff perhaps a bit earlier stage, and those which is that wall of money as you were describing, Alex. And in the middle, it felt like the sort of generalist firms were going to be a bit sort of, well, the world's moved on, and trying to sort of, stick with that model and be a sort of a generalist VC that, raises a bit of capital, places a few bets, hopes to strike lucky, and if not, raise their second fund before people worked out that they weren't very good. That felt like it was going to be a tough place to be. So I just wonder, from your point of view, it felt like SVB worked this out many years ago, and you really sort of have concentrated on those with a track record, or those that really had the experience and were likely to scale up. What do you think that means in terms of the overall number of venture firms that's likely to be in that dead zone as a result, Alex?
Oh, crikey. That's a hard question. Look, again, it depends on stage, right? Because clearly there are hundreds and hundreds of early stage firms out there. Not all of them can get into, unicorn exits. But it'll take decades to play out. So, clearly those funds that truly have an edge that allow them to get into the best entrepreneurs will survive, and they'll be a relatively small percentage at early stage. Now, the sheer number of funds at trying to operate at growth stage also causes a little bit of concern around, well, hang on, valuations have gone up 2 or 3x in the last 5 years, pretty much at all stages. But if you're a hedge fund, or you're some sort of new entrant to growth stage investing in loss-making companies, and you're expecting a 2x return within a fairly short period to meet your hurdle rates, and there's hundreds of other people all doing the same thing, not all of those will achieve it either. So everyone sort of flocked to growth stage in recent years because they thought it was a sensible thing to do, and clearly if you're one of the funds that has got multiple unicorns that are exiting via IPO, SPAC, whatever, great. And you've got a brand name then, and you're then trusted by the VCs to bring you their best deals. But woe betide, a relatively new growth stage investor who's got no real track record either. Guess what deals they're going to be brought? All the also rans. And we're definitely witnessing a bit of that going on at the moment. So, clearly the best capital allocators at any stage know their co-investors and know the next round investors very well, and there's trust, and that's how it works. And we just think that is a solid strategy in current times. Even if this bull run continues for another good few years, some newer funds will make good, but largely, I don't think people can go too far wrong by knowing their co-investors and their next round investors, and really getting to know the best of the best.
That's a great idea. Perfect. And then just for the sort of final sort of segment, the third sort of bullet point, I mean, this is something we've been chatting away a little bit over the past probably 10 years, I think, Alex, if we sort of roll the clock back since SVB. So first kindly supported GCV when we were just getting going. That's been really appreciated relationship in that regard. But I was just sort of interested, perhaps you could sort of talk through how the bank thinks about these sorts of areas, because ultimately the sort of macro to micro, money in, money out, but these aren't sort of one then the other. They've all got to work together as you think about the risks, the opportunities, the trends, as well as the sort of the different component parts. So how does that get done? How do you think about it from a bank's point of view? And perhaps you could sort of talk through some of these sort of areas in that way, Alex, and I'll sort of chime in a bit of what we're seeing as well from a CVC and the broader ecosystem point of view as well.
Yeah, sure. And clearly it depends on your product and your geography and your, returns, risk return appetite. So when we were starting as a bank, and clearly I wasn't there 20, 30 years ago, but, in the last 11 years, I've witnessed a growth of products and a growth of geographies, both on the lending side and the direct investing side, as well as the fund of fund side. So I guess our overall strategy was for each of those products with very different return profiles, absolutely know who your counterparties are, still remains true. However, we are going to try and diversify risk. And one of the ways we do it is obviously geography. So clearly, as new territories came on stream with venture, we found a way to be, expanding from Silicon Valley to different regions across the US first, then into the UK second, then into Europe and China and Canada, and just go where the venture dollars go and figure out who are the best co-investors, the best brand name, in the best company, stay close. But then consider the micro trends, because clearly, in the UK, we saw a lot of fintech innovation pretty early on, given our office was in London and we were, liaising with our US colleagues on fintech. But in many respects, we saw quite a lot of fintech innovation on a micro trend, which also had very different regulatory nuances. So not only have you got to consider the macro, you've then got to dive deep into the micro. And then when you're saying money in, whether in our case it's lending, it's direct equity, or it's an LP investment, you've then got to say, given those two environments, macro and micro, and the counterparties that we're dealing with, how do we best put money in? Now, clearly, if it's a new nascent area, we're not going to bet the farm as a bank on, putting too much out. We're going to feel our way with small amounts, test the waters. We call them buckets at SVB. We allow a certain bucket amount to do a certain new thing in a certain new territory or a certain new sector or niche. And we figure it out, we see how it goes. Before then, over time, working the money out scenario, whether it's money out on a loan or it's money out on an equity investment. And clearly, 2-3 years ago, when we were making direct equity investments, we weren't considering SPACs as an exit route. Now we are, and we're wondering, does that allow us, because of the SPAC appetite in certain particular areas, be it growth, be it healthcare, or deep tech, which has seen a phenomenal rise of SPACs ready to fund, does that shift our approach in direct equity? Equally, if a company's got very little revenue, is heavily loss-making, and is suddenly now a public entity, what does that mean for lending for us? So we have to consider, and we do consider, all the 4 M's on anything we do, whether it's a new nascent thing or, we've been lending for years, up to a certain amount in a certain sector at a certain stage. And all of a sudden, you know, our competition starts coming in and doing big loans, bigger than us in a slightly different way, in a slightly different structure. We have to study it first. We have to try and get our head around the 4 M's before we decide, are we going to participate in a similar way? Or actually, you know, are we going to partner with somebody else to de-risk it, which we have? Yeah, so I guess it's a sort of long-winded general answer for, you've got to, in my mind, consider all the 4 elements rather than just consider, you know, one. I've got one product, I'm in one geography. You know, does that mean with the flow of global capital and ability of people to do deals over Zoom, why aren't we considering, you know, more and more territories? I've certainly seen the rise of CVCs and VCs do deals in recent years in very different geographies. Now, all of that is opportunity led, and that's the green text here. But, you know, clearly, if you're doing deals in a far-flung geography, what happens when it goes wrong? You've got to consider the downside. Do you understand what's going to happen? Is it a bet you can afford to lose? Do you really understand the regulation of what's going to happen in a downside scenario? You've got to equally consider the risks. Add it all up and then go, how does that define my investment strategy? And have I got mitigants against the risk? So, you know, we have to consider very different mitigants for lending versus equity versus LP investments. Absolutely.
Fascinating. I'd love to drill down a little bit more on that. So, funny enough, I've just been reading a sort of review copy of Daniel Kahneman's next book, which will be published next month, which is a great one. You know, Danny obviously won the Nobel Prize for Economics and sort of published one of his books on thinking fast and slow, which was a really sort of good seminal sort of review of his life's work on behavioral economics. And his next one's on noise, you know, which is how do you think about, you know, obviously not just unbiasing yourself in general to say, okay, we need to think more about female entrepreneurs, or how do we understand various different sort of heuristics or biases that we might have that sort of influence the decisions we make. But how do you also understand that you can make different decisions fundamentally at different times of day, or from talking to different people in different orders? That's sort of, you know, a much more sort of influential and important part of decision making. So I'm just wondering, if we take, say, the macro environment, Alex, you know, and let's just say we've got some of the trends around global innovation, GDP growth, demographics. Does that start to say, look, we think the world's going to increase in population. We think GDP is going to rise coming out of, you know, COVID-19, subject to some of the risks affecting us. Our view is that being long only equity is a good place to be. We think perhaps we should be increasing that bucket. You know, does it sort of work on that? What are the sort of trends, or from a macro point of view, that you think, well, actually, we think, you know, fundamentally there might be blips, but ultimately we're on an up and rightward curve, you know, really from that bigger picture point of view for the next generation, ultimately?
Yeah. I mean, so our macro view is that COVID and the pandemic has shown the world that tech can be a savior in many areas, rather than this sort of speculative, or, you know, it's all Silicon Valley led or New York on fintech. Actually, what pandemic's shown is that tech has longevity. Corporates are adopting and investing in tech more and more in many areas, and that's probably set to continue. But, you know, innovation can come from anywhere, and so clearly the fact that we've seen, I think UiPath floated at $29 billion valuation, you know, came out of Romania. We've had other companies, great valuation companies, come out of Bulgaria, Eastern Europe. We're seeing the rise of great investments coming out of different regions. So is that going to continue? We think so. Our concern, just being honest, is the pandemic recovery will be uneven. And so clearly the US and Europe and countries that can afford vaccinations, healthcare, people adhere to limitations, will recover even quicker. And clearly there's great opportunity. So, are we a bit more cautious or on countries where they're not so health centric or pandemic, the pandemic's not quite so well contained? Absolutely. So, sticking to our core markets for the moment, US, Europe, China, Israel, we're betting more on the shift of demographics to, more female and diverse led entrepreneurs. There's a huge wave of sentiment, positively to investing in those and lending to those. So we definitely want to be in a more diverse pool. I think people are more cognizant that, hitherto, pale male stale sort of VC environments probably won't continue for the future, and therefore more diverse investments will be made, which is great. And then I think, clearly the demographics have shifted as we're seeing more and more innovation within. My son, who's 10, is informing me on the latest gaming trends, and my daughter could probably explain coding and AI a lot, to me a lot better than many adults. So I think, looking to the younger consumers to inform us and be on trend is also a key thing. So yeah, many macro trends to consider that are very positive, definitely. But those are the key ones that we're thinking about.
That's really exciting. And then just thinking about the risks, obviously we've put a few down here, the sort of geopolitics. We talked about the antitrust, the regulation side, obviously, given the wall of cash coming out from central banks around something concerns around inflation and interest rate rises, and then potentially further pandemics. And then what about cyber war? Given you're sort of a tech focused bank, how do you start to sort of sift through the different risks, and how do you sort of, I suppose, almost go through a process of adjusting? What sort of triggers or warning signs do you have around those areas? Is it as formulaic as that? Do you start to go, look, we've got our sort of almost dashboard, and as different inputs come in, we start to get that bit more amber, a bit more red? But if you just had to take one of those, what's the number one concern that you have as a bank at the moment, Alex?
Oh, crikey, the number one concern. I think a bank will always look to protect its depositors, and the number one risk to any financial institution is cyber attack. So it's just becoming more and more sophisticated. We're seeing state-sponsored cyber attacks. We're seeing just, black hat hackers. We're employing white hat hackers. The rise of cybersecurity is clearly the counter opportunity. But, it's a big risk when it's just becoming industrialized cyber warfare, whether it's, nations at war or industrial espionage or cyber attacks generally. So clearly the opportunity is in AI fused with cybersecurity, as well as the human intel part. And so we're adopting those things. Other people are adopting and investing in those things. We see that as a huge growth opportunity as well for portfolio companies. But clearly it's a very big risk for any FinServ.
Interesting. Yeah, thanks, Alex. And then I suppose if we, mindful, just in a couple of more minutes, we talked a lot about some of the money in and money out prior, but if we look at some of the micro stuff, I just wonder how much you talked about AI. and the sort of decentralized finance. There seems to be a lot of change, not just within venture, but in finance more broadly. Do you use AI, or how much do you use AI when you think about the sort of lending and or the sort of the direct and LP relationships? Is that already sort of part of the process, the algorithms of how you select?
So the truth is it's a nascent area for us. So in credit analysis, you know, clearly we have a lot of data on past lending decisions, as well as the sort of new data coming in from companies, and we're not there yet in terms of a fully automated lending process, and I don't think we will be anytime, you know, in the short term. But clearly we do have big data pools from our 30-40 year history, but you know, you can't be looking back at more than 5 years worth of data really without it becoming very, very out of date. So we're looking at this area of how do you point AI tools to try and sort of ingest the data that we have and try and make predictions, and then compare those predictions to what the humans already in the loop, you know, say. But you know, that will come over time. Are we there yet in the way that Ant Financial is? No, we're a long way off, but you know, it's coming. Clearly, you know, do we use tools where they're sort of AI infused into some of the cybersecurity tools that we have? Yes. But yeah, more to come from us. But because we rely so much on relationships, as I've said before, human discussion is very, very important to us. And we're not, you know, I think AI in lending is coming and is already there for very small, probably consumer-led loans where there's a massive spread and, you know, a fairly limited homogeneous set of data types, variables that you can get on consumers, like Ant gets, for example, allows them to point AI tools at huge data sets of a fairly narrow number of variables. I mean, that's a good use of AI to automate lending decisions in their case. It's just very different from us being a commercial bank. Interesting.
Well, perfect, Alex. So we're coming to the sort of the end of the sort of the hour. I'm mindful we've probably got some questions coming in, certainly from David and others. So we'll finish this sort of main section before we go to a little bit of Q&A. If you've got a few extra minutes, Alex. You know, as I think Kanye mentioned at the start, from GCV's point of view, obviously we try to do these quarterly sort of webinar series. We do a number of other different sector and sort of regional sort of events, both online, digitally, as well as in real life through the Connect process. Tomorrow we've got one around carbon capture and hydrogen for Earth Day. There'll be a lot of excitement. We just published our sort of Global Energy Council report on that basis. Next week we've got ones on chips and AI in association with the Taiwan government, and delighted to have Stan Shi, who's the sort of founder of ACER, give a keynote at that. Thanks to Martin Hamig for being able to introduce Stan. And then later in the week, we got ag and food, as well as 3D printing and advanced materials. So we've got a number of different sort of discussions coming up, from an online point of view. And then we're coming into the Power List and Digital Forum 4.0 in late January, around the 28th. And then later in the year, as Alex says, hopefully the pandemic starts to ease and we'll be able to get back to in real life, as well as hybrid meetings. We've got the GCVI Summit in California around the 28th, 29th of September, the GCV Symposium in London around COP26, first week of November, November 3rd to 4th. And then the Asia Congress will be the 11th of November. So obviously do check out the analytics from that Kanye helped present. So thanks so much again for introducing us, Kanye, and for doing all the hard work in terms of the presentation. Obviously, my thanks to Alex for being able to join and share and help us think through some of the themes and topics from the first quarter. And I think we did get some questions coming in. So if anyone wants to raise a hand, we can sort of...
Should I read out a question from Professor Hemmick here?
If you can. Yeah, I've just seen him come in, so thanks.
Okay, so given the need for deep tech and life sciences startups to internationalize across continents, what are the recommendations for entrepreneurs and also for their VCs when they have an option to include a corporate or a CVC as an equity investor along on a business deal?
You're muted at the moment, Alex.
Oh, yeah. I think I'd have figured it out after 14 months. But yeah, clearly we're seeing a lot of corporates coming into our clients and borrowers in deep tech and life science. And I think, you know, it's a very good thing where the corporate knows that sector, knows how long it takes in many cases for deep tech and life science to commercialize, and also, you know, the different regulations in different countries. So on balance, you know, I think it's very, very good for a client. And I would certainly say to many clients, you know, please do get a corporate on the cap table that can actually help and does help, rather than say they can help and don't. Secondly, you know, the corporate should, you know, hopefully show willing quickly to try and get into the deal, and, you know, not make it a condition of taking equity to get a business deal, but actually do both, you know, in parallel and separately. I think what can cause some concern is, you know, when a corporate says, well, we're going to do as part of our DD some commercial DD, and we're not going to invest unless the business unit, you know, kind of wants to scale this. Given how nascent some of the technology is, it is quite hard to scale these things. So I think the ideal world is the CVC unit, you know, does talk to the business unit, but they sort of move at their own independent pace.
Yeah, I think that's wise advice as ever, Alex, just given the sort of the breadth of experience and number of entrepreneurs who backed it, can be a sort of a double-edged sword. You know, if the corporate can help, they might be able to help in one country, but trying to then get the business units or the local personnel in a different country to then actually act, you know, is still a really difficult task. I think the general rule of thumb is that at the moment CVCs spend about half their time, you know, on internal discussions, getting the business units, getting the C-suite, getting the various different elements to understand the portfolio, or, you know, what they're trying to achieve or what they would want to be achieved for the parent company, you know, which is a lot of amount of time when they're also then trying to then go out and source and support the portfolio companies. So it's a very difficult challenge, and trying to get that international aspect as well, particularly if, you know, unless it's the home country and they've got the strong ties, you know, it's a difficult one. The entrepreneurs should definitely be asking more challenging questions. It's I think it's one of the things why we're being actually inundated by corporates for our GCV Institute next week. The first course for the Essentials for Enterprise course is being sold out, and corporates are sending dozens of their CVC executives and the executives of the parent companies on those courses to effectively try and minimize some of the time required for you know, for actually sort of being able to just provide some of the basic information, what corporate venture is trying to achieve, how they work with portfolio companies, and how they could best support that from a parent company point of view. So that course is being sold out. The next one's already later this year in June. It's already, I think, been nearly sold out as well, and we'll be doing other courses at different elements, different parts of the CVC ecosystem, you know, not just from a CVC point of view, how do you do it more and better, but also from the parent company, how do you support and land the value back in to the parent company from all this great work that's been done at the portfolio level. So I think that's perfect. Any other final questions? Otherwise, I'm mindful we'll just run over the hour. So I'm probably mindful that Alex's tea might be on the table waiting for him. Certainly a glass of wine hopefully is as well. We really appreciate the insights that you've been able to bring. So thank you, Alex. Much appreciated.
Thanks, Jim. Thanks, Kellyanne.
Right. Thank you once again.
Thanks, Kellyanne. And the next webinar that we'll be doing outside of the roundtables this month that will be on the media sector in mid-May. So thanks very much. We'll speak to everyone soon. Bye-bye.
Bye.